Peps Bed Talks. Ideas worth the snoring. Tonight's Bed Talk, a brief exploration of accounting history for debt contracting. We study the impact of accounting quality on financial contracting by examining the price and non-price features of loan contracts at the time of loan origination. Borrower accounting quality, measured using standard models of unsigned abnormal accruals, has a significant economic impact on the loan contract terms. Lower accounting quality borrowers face substantially higher loan spreads, 17 to 23% higher than the average interest cost. Simultaneously, lower accounting quality borrowers also face stricter non-price contract terms for loan maturity, 6% lower, and collateral, 11% higher probability. Loan transaction costs are significantly higher for lower accounting quality borrowers, with higher upfront fees, 16 to 37% higher, and higher annual fees, 50% higher for the lowest accounting quality borrowers. However, such measures of conservatism do not distinguish between unconditional conservatism and conditional conservatism, making it difficult to draw clear inferences on the benefits of conditional conservatism in debt contracting. An example of such a contractual adjustment is income escalators, which systematically exclude a percentage of positive net income from net worth covenant calculations. In 2010, studies conducted by Professor Minnis explored the hypothesis that audited financial statements are more informative than unaudited financial statements in private firms. Specifically, he argues that audit verification of firms' accounting process and reporting gives financial statements greater credibility, resulting in a lower cost of debt for audited firms. Using an endogenous switching model to control for the voluntary choice of using an auditor, he finds audited firms have an interest rate 69 basis points lower than non-audited firms. Further, he observes audited firms' cost of debt is more sensitive to variations in some financial statement variables than non-audited firms. In more novel evidence, Minnis provides a mechanism for why firms with audited financial statements have lower cost of debt. He argues that audit verification improves the predictive ability of reported net income on future cash flows. Commercial bank loans are a significant source of financing for firms, with syndicated loans accounting for 51% of new capital issuances. Banks tailor loan contract terms for individual borrowers based on a detailed analysis of financial statements. The quality of information in financial statements could be affected by self-interested and opportunistic discretionary accounting choices of borrowers. Thus, poor accounting quality leads to problems in assessment of the true economic performance of borrowers and has important implications for loan contracting. It is important to weight the impact of the accounting quality on the design of loan contract terms using a large sample of commercial loan contracts. Since banks rely on accounting information, amongst other sources of information, to set these terms, we investigate the impact of a firm's accounting quality on contracts terms, controlling for other known proxies of credit risk. Our attempt is to examine the link between accounting quality and design of price and non-price terms of debt contracts. Regressing 1 year ahead, cash flows from operations on contemporaneous net income, we find net income better predicts future cash flows in audited financial statements compared to non-audited financial statements. Decomposing net income into its cash flow and accrual components, we observe that both cash flow and accruals have greater persistence for audited firms than non-audited firms. These findings are consistent with recent evidence that suggests auditors do affect financial reporting properties in private firms. Finally, partitioning the sample by firm size, we find both the interest rate reduction and the improvement of net income predictive ability from auditing is concentrated in smaller firms. Therefore, it could be argued that auditors have incrementally more expertise to enhance smaller firms' accrual estimation process, as smaller firms have weaker internal accounting capabilities than larger firms. In line with extant literature, see Francis Lafond, Olson and Schipper 2005, we measure accounting quality using the magnitude of abnormal operating accruals, that is, the difference between a firm's earnings and its operating cash flows. Controlled for industry and normal level of activity, greater the magnitude of the abnormal operating accruals, lower is the accounting quality. This measure is intended to capture the degree of discretionary accounting choices made by the firm. Large abnormal operating accruals represent abnormal deviations between earnings and operating cash flows and make it harder for the banks to estimate the future operating cash flows of the borrowers using financial statements. Hence, large abnormal operating accruals can result in forecast errors on future cash flows estimates. It is critical for the bank to forecast future cash flows of the borrowers accurately, because payments to loans will be serviced from future cash flows. Our results are summarized as follows. Using three alternative metrics of accounting quality, absolute abnormal operating accruals, we find evidence that there are substantial differences in bank loan contract terms relating to borrowers' accounting quality. The alternative solution of discounting future anticipated gains and losses before recognizing them in the income statement also suffers from reliability issues, as the relevant discount rates for such computations are highly subjective and would allow managers substantial discretion to manipulate the recognized gains and losses. Borrowers with higher magnitudes of abnormal operating accruals face more unfavorable loan contract terms. In univariate tests, the interest spread charged by the bank between firms in the lowest versus the highest quintile of abnormal operating accruals increases by 80 to 87 basis points. In multivariate tests, controlling for various measures of firm and loan characteristics, we find that firms with high abnormal operating accruals face significantly higher cost of bank debt to the tune of 32 to 41 basis points. The additional cost is economically significant, as it represents an incremental interest cost of 17 to 23% over the average interest charged on debt in the sample. With respect to loan transaction costs measured by upfront fees or screening costs and annual fees or monitoring costs, we find that these are increasing across quintiles ranked in increasing order of abnormal accruals. Upfront fees for the highest quintile of abnormal accruals are 16 to 37% higher, and annual fees are about 50% higher than for firms in the lowest quintile. Finally, with respect to non-price terms, we focus on two important dimensions of loan contracts: maturity and collateral. In univariate tests, firms in the highest versus lowest quintiles of abnormal operating accruals face 13 to 17% lower maturity, and the likelihood of being required to provide collateral increases by 18 to 24 percentage points. The solution to this problem is not for regulators to simply disallow fair valuing of liabilities, as fair valuing of assets could lead to significant accounting mismatch both in the income statement and in the balance sheet when an asset and liability are economically related, but do not satisfy the stringent rules needed for these items to be accounted as a hedge. Controlling for asset maturity in addition to other firm and loan characteristics, we find that moving from the lowest to the highest quintile of abnormal operating accruals reduces the maturity of the loans granted by about 6%. Similarly, in multivariate tests, we find that a change in abnormal operating accruals from the minimum to the maximum increases the probability of collateralization by 11.3%. In our sample, on average 77% of loans are collateralized, and so poorer accounting quality has a significant economic effect on borrowers by way higher collateral being required. Since banks set all contract terms simultaneously, we also model the maturity and pricing decisions of the bank within a simultaneous equations framework. The results from the simultaneous estimation show similar economic and statistical results as compared to the single equation estimates. Prior literature on debt contracts has proposed that income-increasing accounting choices are optimal borrower responses in different situations. If this limited information is a source of risk for the bank, in principle, it should be diversifiable and need not be compensated for. However, as Harry and Crown show in the context of the Capital Asset Pricing Model, CAPM, the systematic risk of securities is affected by the amount of available information, and thus limited information is indeed a source of non-diversifiable risk. Hence, one interpretation of our results could be that the adverse price and non-price contract terms for high abnormal accrual borrowers reflects the bank's compensation for information risk arising from lower accounting quality. To provide support for this interpretation, we conduct an additional test to see if abnormal accruals proxy for limited information. If abnormal operating accruals proxy for the relative lack of accuracy about future operating cash flows, the predictability of future cash flows should be decreasing in our measures of abnormal operating accruals. Another alternative solution would be for debt covenants to explicitly require the use of face values for liabilities in computation of net worth and accounting ratios. However, this disallows borrowers from matching fair values of assets with those of hedged liabilities, but which do not qualify for hedge accounting. We find a pattern of decreasing R2 across the accruals quintiles for a regression of firms' cash flow from operations on past cash flow from operations and earnings. The lower predictability of future cash flows for higher abnormal operating accruals, firms provides support for our interpretation of the abnormal accrual metrics as a proxy for limited information. Hello? Are you there? Still awake? Really? Perhaps we need to find something infinitely more tedious to overcome your incredible tolerance for auditory boredom. Or perhaps your wakefulness has less to do with the lockdown and more to do with your mattress. In which case, may we suggest that when things get back to normal, you visit a Peps Great Sleep store near you. You'll find simpler ways to fall asleep.